Hello and welcome. My name is James Boyd. Today's date, April 21st. Hopefully that spring is coming where you are. This session is called the Investing Master Series, where we talk about in more in depth of stocks and options. Now, we mainly will talk about options that kind of might be more basic options in combination of stocks. If you'd like to learn about ETFs, check out Monday afternoon with Rachel Dashel or myself and Kevin on Friday morning. That will complement this class if you kind of want to learn about that topic of ETFs. But our focus will be stocks and basic options. Now, also, when we get started here today, I'd like to welcome all of you here today. Hello, Silas. Uh, we'd like to welcome Willis, Grace. We got Brett with us. Welcome, Brett. And Fayez, Scott Luck, Life in the Fast Lane, Rojo, and many others. Welcome all. Now let's go ahead and get started. Just real quick, you could follow myself, and let's bring this up. So just real quick, this class is being recorded. It's being broadcast via YouTube. You went to youtube.com, typed in Trader Talks Schwab Coaching Webcast. You're going to see that's our channel. On that page, what you're going to notice is there's previous sessions that are actually broken down by playlist. There's also a search capability as well. Make sure that you're using that. Sometimes you can actually type in certain things you like to learn, and if you subscribe for free and you click on that right there, you can search for different content that we have on our channel. Also, a quick reminder that Brett teaches the short verticals throughout. Actually, check me. I believe it's on Wednesday, and right after the class, so it's going to be 12 Eastern. Okay, and he teaches that short verticals. Check me. It might be Thursday. Okay, sorry, I teach each day, and I think it's Thursday. He teaches the short vertical class. This is Brett Crowther. Feel free to follow him right on X. By the way, good looking family. I'm just saying. Okay. My face maybe not as pretty as that previous family picture, but a little fun with Brett there. All right. Now, just real quick, so feel free to follow us there. We do post educational content there and announcements. And also, just real quick, if you pay attention to this page as well, the coaching page, and that right there, if we went to, let's say, Learn Schwab Coaching, right there, don't even have to log in. If we went to live webcast and virtual workshops, speaking of the class schedule, let's double check when Brett teaches. Brett is actually teaching. Let's go down to the 21st. Yeah, there it is. Thursday. Okay, so there it is. Okay, I knew something was wrong. Now, just real quick, let's go ahead and get started. Remember that with what we discuss here today, as we talk about stocks and options, remember that options carry a high level of risk and are not suitable for all investors. The information we talk about here today is done for general informational purposes only. When we talk about our examples, we will do those on the Paper Money software application. Now, I kind of mentioned yesterday that this class is on investing. Investing is not just stocks. So there's different strategies. And so we have different accounts, 401k accounts, maybe Roth accounts, whatever, margin accounts, and so on. So there might be maybe considerations to try different strategies, and that's what we talk about. Now, remember that investing involves risk, including loss of principal. And also remember when we talk about short options, which we talked about trading short puts 2 weeks ago, and hopefully you've got some practice. We're going to swing back to that a little bit here today as we talk about some examples that might need to be exited or rolled. Now, when I say the language of roll, I'm just saying buy what we have back and maybe consider or selling a new one. Also, remember when we talk about if we bring up REITs, they're similar to the associated with direct ownership of real estate. So understand that what the differences are there. Now, in our class, we'll talk about some of these market conditions. We got the U.S. going back to Pakistan, talking about round two of the talks, and we'll kind of talk about how that's playing out with crude oil and the VIX. Now, when we talk about actually the market, we'll bring up some of the sectors. I do think we need to bring up industry groups. Okay, there's some movements in the industry groups that are being different, and I want you to tell me which ones they are. We'll talk about United Healthcare, and maybe is that kind of helping getting some of the moves in the market in the sector of healthcare? And then when we talk about the industry groups, we're going to bring up some different stocks we haven't brought up as of lately. So let's go ahead and hop right in. So first off, if I bring up the SPX, here we are on the SPX. And what I'm going to do is Uh, Now, if I look on the left-hand side, okay, you're now going to notice, let's go back to the SPX. Let's just resync that. So the SPX, when we take a look at this, we're down 19 points, or in other words, 0.2%. Now, you got to remember going into those talks, okay, some people might say, hey, I've been riding a trend as of late. Some people, they might start to profit take on some of those names. We know that when some people profit take, they set stops and or adjust those stops. Some people buy puts as a way to maybe define the risk, but also try to lock in the profits where they actually have a right to sell at the strike price. Now, if we get the price to fall down below the shorter term moving average, the 10, and the 20 period moving average, the 20, well, that shorter term moving average might start to turn red. We've talked about that really being the whole moving average. That's the first sign of selling pressure. Okay. Now, if someone is going to sell on the first sign of selling, it's when that short-term period moving average turns red. Now, we don't have that yet, but we know what causes that. What causes that is that price starting to close down below the moving averages, which then causes the moving average, the 10, to go from green to red. So this is where the investor might say, hey, I'm not going to move up the stops and manage some of these bullish positions, okay? Now, when we look at the SPX EW for just a moment, okay, you're going to see that the equal weighted S&P 500 did actually go up and make a brand new high here today, okay? Now, you got to understand something. If they come out of that talk again, let's say there's a deal, okay? Maybe the market likes that, continues higher. If they actually come out of it and say there's no deal, you might see that increase of volatility still, right? So when you look at the equal weighted, that is a good sign that it's not just technology or discretionary by itself. You're seeing other sectors move. Now, by the way, does anybody know the ticker symbol for the S&P 500 equal weighted sectors? Keep that in mind. Okay. Now, the other thing I want to kind of bring up here is the SPX A50. Okay. The percentage of companies above their 50-day simple moving average that has also been moving to the upside, which is a good sign. More stocks trading above their 50. If we said, well, what about the 200? Okay, you're going to see that that has also been moving to the upside. Welcome sign there. We actually say, what about the 100? If we put that right there, and that has also been kind of cranking away. Now, this morning, seeing a little bit of a fade back, okay? But you like to see all those, the equal weighted, the percentage of stocks above the 50, the 100, and the 200, better signs, okay? Now, if we also take a look at just real quick, since we're on the S&P 500, the VIX, okay? Now, you got to understand, like, kind of this discussion, going back to Pakistan, right? We're seeing that the VIX has crossed over. Now, when the VIX has crossed over, meaning the shorter term moving average getting above the 20, what does that mean? Well, if this VIX is crossed, if we're seeing the VIX go up, that means some of the stocks, like we saw in the SPX, they might be getting down below their moving averages. Like we just said, right? Someone might just be manually exiting on some of the positions. 2, raising the stops. 3, buying the puts, and so on. Doesn't mean that someone necessarily goes bearish. Well, no. Setting a stop, you're just trying to protect to a degree. Buying a put, locking in the potential gains, but it's not free, it's not forever. And really the third point, which is you're trying to protect the position, the profit, that's unrealized gain, if there is, and or the portfolio. Okay. Now, if we take a look at this, we don't see a divergence here on the VIX, but there is a crossover. So when we look at our portfolio on the paper money account, it wouldn't be a surprise to see that some things are pulling back. Super quick on the NASDAQ front. NASDAQ, is it pulling back? It doesn't look like it's pulling back as much as the S&P. Okay. The SOX, just real quick, what is that doing? That's a brand new high in the semiconductors. We don't even see the red candle today taking out really the low from yesterday. So technology still showing some strength there. Now, by the way, type in the chat which industry groups in the technology space have been getting a little love, meaning some bullish activity. Now, type that in the chat. I'm going to swing back to that for just a sec. Russell hit a brand new high here today. We'll also include the mid caps here. I'm going to use this ticker symbol because I can't bring up the ETF version of it. But we also did see the Russell actually hit a brand new high today, and the mid caps actually hit a brand new high. And the large caps, what do we got? Those did hit a brand new high in the short term, faded back here today so far. Okay. Now, Sam actually says health. Now, let's kind of go just real quick to the sectors for just real quick. So first off, I like to actually have, as far as my teaching, right? The futures, the indexes, the sectors. Let's just work from the top down, okay? First off, transports. Oh, okay, transports. What has been moving in the transports? Now, by the way, it's not just airlines, okay? It's been the trucking companies, ODFL, JB Hunt, and so on. Again, if those transports are going up, that's typically usually not a bearish signal, right? Okay. We already talked about the semiconductors. Go down to the third one, technology. I mean, we joked last week, this is not Hakanashi candlesticks. These are regular candlesticks here, ladies and gentlemen. And they have been, well, let's just say the word green. Now, the one thing you're going to notice is we also see discretionaries, okay, there. Those discretionaries, which, by the way, the backbone of discretionaries is what stock? Can you name it? The backbone of discretionaries is what stock? It starts with an A, ends with an N, and you probably get a package occasionally. Yeah, Amazon, okay. Energy, is it getting a move? Not really. Trying to turn around, but divergence so far on energy, okay. Financials. Financials continue to see that short-term strength to the upside as well. I think the other ones we need to pay attention to is communication. Think of this as Meta, Google, and so on. Real estate has also been pistol hot, seeing some profit taking actually here today so far. And those are the ones we actually noticed so far. Now, when we talk about the industry groups, man, cloud services. Okay, if you come to the ETF class on Friday, we go through these each week. Cloud services, we also saw internet services like CrowdStrike, software, retail, and I think we need to also bring up copper. Okay, now let's go to work here for just a second. Now, when we actually go down just real quick to, let's say, the Dow Jones here. So let's go down to the fourth list, okay? So one of the areas that we actually saw some movement was in UNH. Now, UNH had really been in a, well, I mean, it had, ever since the CEO was killed, okay, that company struggled, to say the least, went very sideways. The healthcare sector, when you talk about the group, the biggest name in there is United Healthcare. Finally got a pop here today. The earnings was much higher than where it had been historical. Might want to keep an eye on some of the healthcare names. Salesforce, when you talk about the software, trying to get a little reversal here. We'll swing back to that for just a sec. And then Amazon, okay, kind of added a deal in the AI space. I mean, we're high, but that stock not really fading away from the 250 level, okay? There's the software again, okay? Little pushback there, getting above some resistance levels. And let's just finish with these last two stocks. Caterpillar, meow, okay, brand new high. Don't act like you're surprised. And if we look at the Cisco, okay? Now, Cisco has been one of those names that we've actually had. Now, I want to kind of just take a quick break for just a second, okay? So remember we kind of talked about, we're going to look at some of the names we haven't normally talked about. Now, first off, when someone looks at sectors, indexes, or something that tracks the index, sectors, industry groups, someone just might buy the sector. Someone might just consider buying the industry group. That's a consideration, okay? If someone says, look, I'm not going to do that, and by the way, that's what not our class is on, but I just want to throw that out here, that might be a consideration for some of you. Our class is on stocks and options, okay? So if we said, geez, I'm going to go back to the Salesforce for just a second, And what I'm going to kind of think is we know that when stocks go down, 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 those bears are probably going to try to stay in the bearish position as long as the trend line holds, the resistance. Okay. Well, today, what we actually saw in this case is Salesforce in the last 2 days, well, 2 days ago, I should say yesterday, price on April 20th opened and closed above the trend line. The trend line created from lower highs. Now, let's kind of say, for example, given that we don't have that much capital left, and that's true, we don't. Okay, most of our capital has been deployed in stock positions. And it's very easy to chew up capital with stocks, very easy to do. So let's say the investor said, now Brett teaches the class on Thursday on verticals, short verticals. So if we said short, so first of all, we have to kind of pick our posture. We want to be bullish or bearish, right? If the investor said, look, I want to be bullish, well, that would be a short put vertical. Short put vertical is really like, well, it's selling the put, okay? Think a cash secured put, but then buying the put below for downside protection. There's reasons why you do that. Lower the delta, created a max loss, and you're actually making it where you're more neutral to volatility. So you're trying, of the option Greeks, which option Greek are you trying to trade the most? Delta, gamma, theta, vega. The answer is you're trying to trade delta with some theta. Yes. Now, let's say the investor said, look, let's go to the paper money trade. Trade number one is we're going to go try to trade some of these software names, okay? CRM. Now, the first thing is what we're going to do is we're going to go to that margin account, and I'm going to bring this up. And first off, when we look at this, we got 24 days left. If we have 24 days left, we could look at the May monthly options. There's more than 20 days. If we go look at, let's say, look at the open interest, I just want to verify which option contracts are traded heavier. So you're going to notice that every 2.5, those do not have that much, okay, open interest. Not a lot, not a lot. And let's imagine the investor said, look, I want to kind of do something in the range of that 30 to 40 delta we talk about. Well, that would be selling the 185 put and then buying the 180. So trade example number one is we're going to sell the 185, okay? And then what we're going to do is we're going to buy the 180. Now, let's kind of talk about this position sizing for just a second. So if we look at the paper money account and said, okay, we're willing to risk 1% of the account value. Well, if you had $45,000, 1% of that would be $450. All right. Now this is, I can't say this is super advanced. What I've seen in my time in doing this is people struggle with kind of figuring out how much they want to risk. Okay. So that's step number one. How much are you willing to risk? The answer, okay, if you said, I don't want to risk anything, you got to evaluate that. Is that realistic? Okay. We know that without taking risk, there is no reward. Okay. So if we did a $5 wide spread, we would say, look, I'm willing to risk 1% of that balance value currently. And if I did the $5 wide strike, okay, you're going to see that per one contract is 323. So in this case, we could do one contract. Okay. Can't do more than that. Now, if we did this in the IRA, we could do more, probably two contracts and so on. Might even do the 185.75 because it could risk more. Now, if I looked at this and said, well, what's the numbers? Now, remember we said before, investing is math and psychology, okay? So if you want to be an investor, we need to be good with some basic math. How much are we trying to make? 177, we'll type that on the calculator. Divide that by the max loss, given the vertical, 323. And now what you see is the ROR, 54%. That's pretty interesting considering we're not at the money strike. We don't have 40 days to expiration. And the only thing that would kind of lead us to believe that, why is that so high, you know, greater than 30%, the implied volatility is higher, okay? And that's true, it's at 48%. So now remember, if the max gain, is less than the max loss, This tells us this is a probability type trade. So you're going to see that the current stock price is at 190.96. The break even, not today, at expiration at 183.26. And what we could do, if we wanted to, is I'm going to say single order first triggers SEQ. We're going to try to set this up and say create opposite order. Now, I don't normally do this. Why? Because I try to include you in the learning process. And I don't want these to buy back, but if you said, James, I don't teach a class, I'm not trying to carry these positions to teach a webcast, etc. And you'll see in just a sec how we need to manually do this. Well, wonder if you just want to sell it and say, look, I want to try to buy it back for 20% of what I'm selling it for. Well, if that's the case, we'll try to buy it back for 34 cents, limit that price or less, confirm and send. Trade number one, short put vertical on CRM. Now, remember, if we take a look at this, note the commission, 65 cents for selling the put, buying the put, that's why it's $1.30. What's the max loss given the vertical? Answer, $323. Send the order. Now, I want to go back into this just real quick, and we need to talk about some of these just really quick, okay? Now, if I look at an example given like a short put, now 2 weeks ago in this class, we talked about short puts. Now, sometimes someone might say, yeah, you're just doing short puts because you're doing options. Well, here's the deal. It's short puts, that's true, or cash secured puts. But cash secured puts is you have a dual mandate, which is A, you're trying to buy the stock at a potential discount. Don't forget that. Okay? 2, you're trying to actually get some income. Okay? So number 1 is you're saying, I don't mind to buy the shares at 300. 2, give me some income, potentially. Let me try to buy the stock at a discount from where it is now. Well, one of the trades that we actually took on 4/8 about 2 weeks ago, you're going to see was really American Express. Now, sold the put for $7.35, and you're now going to see it's at $2.28. Now, quick math. Remember, math. We're investors now, okay? Can't say stuff like we're not good at math. Well, how are we going to be an investor? Well, if we're at 507, if we've made $507, 507 is what we're up now, but the max gain we could actually make is 735. Divide that into by 735. So we're up about 69% of the maximum gain. Now, the rule of thumb we talk about is if we can make 50% in the first how many days? Give it to me. In the first 10 trading days. 65% if we have more than 20 days expiration, and 80% ever. Well, it looks like we've ticked box number 2. Okay? We're greater than 65%. So what might the investor consider? Now, this is where I need your help. Okay? So if I pull up this American Express on the chart here, okay? Now, if this works out, I'm going to say, yeah, just like I thought. If it doesn't work out, I'll blame you. I'm joking with you, okay? Now, if you said language like, James, there's earnings coming up in 2 days, and I don't want to be holding this short put over earnings, which is the obligation to buy the shares at the strike price, you might decide to do what? Exit the position or roll the position? Well, the answer to that question and fill in the blanks is you might say, look, I'm just going to take the 69% and run for the hills. Okay. Just take the money and run. Okay. If you can get a fill. If you said, no, James, I actually don't mind to hold over earnings. Now, let's decide. Okay. Now, Pia, why am I not surprised? Okay. Higher premium, higher volatility. Okay. Now, let's say we decided the latter, that we're going to roll this. So first off, let's go back to the position, okay? So number 1 is we're going to right click on this one, okay? And what we're going to do is say create closing order. So we're going to try to take the $506. We're going to try to take it and stuff that paper money right in the envelope, okay? I'm going to try to buy it back. Now what I'm going to do is going to buy it back. And notice the mid price, 229. Let's go back and just verify just real quick. Where is that? It's not even there. I need to open up the number of strikes. We go back down to 300. Now, the purpose of this class, you're going to notice this sometimes is when you get farther and farther out of the money, look how wide the bid-ask strike is. Bid-ask spread is, excuse me. Bid-ask spread is on the 300 strike. So that's why right there that it's sometimes when you're going into earnings, if that volatility is higher, it might be tough to get that fill. Now, this is pretty abnormal from what I've seen with American Express, but I'm on the paper money account. I'm going to go 229, which is the middle of that. Bid-ask spread, confirm send. Note the commission, send the order. Now, the other thing that we're going to notice real quick is if we decided, hey, James, I want to maybe try to go out, I want to stay in the position or try to enter a new position, but I want to go farther down on the option table, meaning a lower delta, okay? So if we decide in this case, now notice these strikes, now for this example, and let me go to the June just real quick to see what we got here. If I go look at the Junes, I'm going to go to the Junes. Now, when you start getting about 20 days to expiration, you got to be careful that not everything in your portfolio is June, let's say May expiration or that current month. Because if in the next 20 days, the market goes down and these are bullish positions, all of your positions are in the same duration of time. So this is where I'm going to go farther out. We did not like the bid-ask spread on the monthly options to go over earnings. This still has a pretty good implied volatility, but we're going to go look at selling the strike that has a delta below the normal range we talk about. So trade number 2 is we're going to sell the 310. Now remember, what are you doing? Now, we're also going to kind of say, well, if you sell the 310, what's the risk? Well, the risk is the stock can fall to 0. Okay. Number 2 is we might not like that. The other thing is you might say, James, I'm doing this in an IRA type account. With that being said, let's imagine that we were doing that in an IRA type of account. If we sell vertical, this is not the vertical that Brett teaches or that we typically teach as well. We're going to widen this out. So we're selling the 310, but then we're buying a put with a delta of, let's say, 10 or less. We could look at this one, but that's a wide bid-ask spread. Wouldn't look at that one. We'd probably look at this one, the 270, a little bit narrower there. So I'm going to go down to the 270. Now, if you think about this, if you sell the put, you're really saying, look, I'll buy the shares at the strike price. You're obligated to buy the shares at the strike price from now to expiration. Second, you have a right to sell the shares at 370. Now, if we did this, let's say, example given in an IRA account, you're going to see the differences. If this was in a margin account, it's setting aside $3,404. If we did this in an IRA account, okay, it's setting aside $3,404. Why? Because whatever the max loss is, that's what the buying power effect is. So the max loss is the buying power effect for the margin or the IRA account. What's creating that? By buying that 270, it creates a max loss that's not showing as bad as if the stock went to 0. Now, the con about that is it makes your credit lower. The con about that is if the credit is lower, your break even's higher. The other con, not trying to be negative, but just trying to show the counter of this trade, you got to pay the extra 65 cents. Even though I gave you 3 cons, you might say, well, those 3 cons, it's not as, if you don't do it, you have to set aside a lot more capital to be in the trade. Does that make sense? Okay. Now, how many of you, when you sell puts, so first of all, how many like doing cash secured puts? How many, when you do cash secured puts, whether it's the margin or the IRA, you like knowing that there's a right to sell higher than zero? How many of you like that? How many of you also like knowing that you don't have to set aside as much capital? Okay, I mean, you can decide for yourself. I'm going to go ahead and put that back in the margin account right there. Send the order. There it is. Now, let's also go back to the other area. So I want to kind of bring up, just kind of show a couple stocks real quick. So what we did, so what was the first trade that we did? What was the first trade? Well, that first trade, if we went back to this, what was the first trade? Type it in. The second trade was American Express. Okay. Yeah, the first trade was CRM, playing a little reversal on CRM. The second trade was American Express. Now, you could say the first one was kind of more like your classic short put vertical, tighter spreads. The second trade, if we kind of had to classify it or categorize it, it's really a cash secured put with downside protection. Okay. Now, what I want to do just real quick is let's go back to just real quick. Let's bring that up. And what I want to do is I want to kind of just bring up just real quick any others that we need to bring up. Okay. Now, I just want to verbally speak to one that we had before. Okay. Now, remember, last week was expiration. Well, you know what happens on expiration. If it doesn't, if the stock is not, if the option is not in the money, those options could or should expire worthless. Okay. So remember on CSX, we had 100 shares of stock, right? Okay. 100 shares of stock. We bought the shares. And then what we did is we bought the put. Now, what type of strategy do you call that? Where you buy the shares of the stock and then you buy the put and you buy those at the same time. What do you call that? A married put. Okay. Buy the shares at 40.13 and want to have a right to sell the shares at 39. How much did you pay for the strike? Well, we paid 68 cents. So it's not really backbreaking. Now, what happened? So if the stock closes above 39, what should happen? Well, the long put drops off. What are you left with? The shares. Okay? And so that's why right there we still have the shares. The long put expired worthless, and now this position is not a married put. We're going to move it right over to move to group, and we're just going to say this is your just good old stock position. So we'll move it up right there. Now again, what is our favorite color in terms of the trend? Trend 3. Trend 3 is the price above the 10-day exponential and the 30-day simple. So I just want to kind of point that out. Now, the one that we also want to go back to for just a moment is I want to also bring up the example of Target for just a second. Now, Target has been a horse to the upside. Now, this might be confusing because when you look at Target for just a sec, and we're going to do a new position, but we need to talk about this. When you look at this position, it's confusing because you're like, wait, the trend actually says 1. The trend says 1. Is that the trend for the stock price or the option price? That's correct, Vic. Yes, that you're correct. Don't doubt yourself. Don't ever do that. Okay. Yeah, that if the trend 1, that's for the option prices. Now, by the way, that's for the put prices. That's not bad to have trend 1. Now, why do we need to talk about this? Well, because we sold the put for 450. And we remember the 450 is the most that you could make. And so you're trying to sell high and buy back low. Now, if you sell the put and the price goes down, it says one of 3 things. Number 1, the stock price went up. Number 2, the time goes by. Poof. And number 3, the volatility contracts. The triple whammy effect. And boy, you like that. Now, the big thing is when you take a look at this, is if I go back, we're going to roll this position. Now, wait, what does roll mean? Roll actually means that we're going to get out of this position with 24 days. And what I'm going to do is I'm going to create a rolling order. Okay? Now, when I create a rolling order, we're going to get out of the position we have now. And what we're going to do is we're going to sell a new vertical. How do I know which one is which? The position that you're exiting is on the bottom. Okay? Second, we now have to ask ourselves, which expiration would you consider? Now, James, you didn't show me the chart yet. Show me that chart. That's all you have to do. Just ask. Now, if we bring up target, this is what it looks like. So a lot of times you're going to find that you're going to roll positions when you're in the top or near that top of that bull flag pole. Now, option number one here is just roll it now when there's the gains. Option two, profit take on that position and let that stock fall down a little bit. Now, I know some of you are saying, James, yeah, that's exactly what I would do. Okay, but let's just say that we don't have the time to do that, okay? If you're trying to time that, you might say, I'm going to try to take the gain in the bull flag pull, the price going up, the gains on that short put increasing as well. Well, what we're going to do is we're going to go, now remember, when is the earnings on this one? 5/20. So I'm going to go back to that page right there. Let's open this up. Let's go look at the June expiration. We cannot assume anything. Verify with own eyes. Let's say we're going to start to focus on some of these June expirations. Well, if I go look at the June expiration, which strike has really an expiration where it has a couple thousand? There, a couple of them, okay? Now, let's just double check the volume open interest for just a second. Spend some time talking about that. Today, we don't see any high volume on those today, but there has been open interest, okay? Now, what I'm going to do is I'm going to go back. Let's put that back. And what I'm going to do is we're going to sell the 125. So first, change the expiration to the 18 June, the monthly options, selling the 125. So the language that we're learning here is we're rolling out in time in duration, and we're going up in strike from 120 to 125, and then buying the 120 put below us. So third trade, okay, and that's the way you learn trading is you actually trade. What a shocker. We're actually going to go out in time and up in strike, okay? Now what I'm going to do is say confirm and send. Note that it's being able to roll for a credit, less the commission. And we're going to go ahead and send it. Okay? Now, are there any questions? Now, the question was, is TGT trend 1 or 3? So when we go back to that question, TGT, the options, when you look at the option price, it's trend 1. Okay, when you bring up the stock price on a graph, we'll just verify trend 1 or 3. The answer, it is trend 3. Price above both moving averages, and you're going to see that let's just call it an oscillator. In the last 4 days, it's really been in trend 3. Okay, now. The comment is, why do we choose a $5 wide strike? Well, just to kind of match what we actually had. That was the one. I just want to double check. So what we did is on this is we went from the previous example was really a cash secured put, the 120, 100. Okay. To try to stay on that main vein of a vertical theme here today, you're going to see that we went and we kind of narrowed the strikes. Now, if you said, James, I don't want to narrow the strikes, and I'll tell you why I did that, okay? The biggest actually thing is we went from a wider spread, which is like a cash secured put. We went to more of a tighter spread. Why? Why did I do that? Well, the reason why I did that is I was kind of thinking that maybe the price might flag back a little bit. And which type of strategy would be at more risk of directional exposure? but it's going to be the wider spread. Okay. Now, if that stock flags back, could we try to layer on top a wider put spread? Oh, sure. Okay. I think I've said a lot lately, dollar cost averaging or layering contracts on contracts. So the reason why I did is in this example, tighter strikes, kind of accounting for that we might be in the pull itself, and if we flag back, narrower spread would not be as at price risk or directional risk as widening out the spread. That's why. But if we get that flag, man, could we try to relayer back on in the paper money account a cash secured put with downside protection? Sure. Okay. We'll watch that. Now, any questions? Okay. The question was, so let me share this just real quick. So I'm going to do this in two different ways. This chart, which many think is very helpful, okay, that's the link there. If you said, I would like pretty much all of that grid, that's this one right here. So the first link I sent to you is the individual trend graph, okay? The second one I sent you is the package of charts that we're showing, okay? Now, what I want to do is I want to kind of also show just a couple other stocks that some investors might be watching in the next couple of days. So first off, we mentioned Microsoft, but you gotta understand something. Many stocks they don't typically go down forever. Some investors they might be looking for some of these stocks that might have been oversold, if you will, that they might try to reverse. Example given, we talked about yesterday, 5 dip buying setups. Well, speaking of dip buying, you're seeing the price ran up, pull back 2 days, and then we actually see a little bounce. Now, we mentioned 5 setups. Which one is this? 1, 2, 3, 4, 5. Now, by the way, there could be 2 answers. If we had to isolate to one, we said old resistance being new potential support. That was strategy number 1. This is kind of like strategy number 1. If we had to say, look, what's the other type of one? Well, we would say it's strategy number 4 as well. Okay. But if we had to isolate one, it's really 1. Okay. Keep an eye on it. Microsoft got earnings coming up on 4/29. Now, the other one that we want to kind of keep an eye on is the Amazon example. Yes. Okay. When we go back to Amazon for just a second, we pull this back up. Now, remember what kind of made mention is the divergence. Okay. When you see these divergences on the weekly charts, you got to think to yourself that, look, those long-term charts probably dominate the daily charts. And then what you're going to notice is this is and I think people discount this. Don't discount this. This is the highest MACD we've seen in a long time. What does that matter? Well, remember, if you have a high MACD or it's staying high, the chances that you break through the resistance becomes higher and higher. People discount that. They don't really put those two things together. We did now. Don't act like you're surprised if this actually breaks higher. When we go back and look at this chart on a 3-year weekly chart, we got to ask ourselves, look, with the MACD being the highest we've actually had on a 3-year period, the likelihood that we take out this prior high is not surprising. Now, if someone says, look, I don't want to have an option trade where there's an expiration or a max gain built in, etc., they might try to choose something that might has unlimited potential. Well, a strategy that has unlimited potential on options, long call, long synthetic. Okay? Long call, debit. Higher break even. Long synthetic, maybe a debit, but it's less than the long call. Higher delta, lower break even. Now, what I'm going to do for time's sake, because oh my gosh, I'm out of time. I'm going to kind of look at this and say, look, let's imagine the investor said, James, I want to go out, and some of the comments you said, I'd like to go look at some longer term type of trades, not something that's shorter term in duration. I want to go out to September. I want to use like a long call here to kind of have some longer time to let the trend play out. Now, when you do that, the debit is higher because you're buying more time. In our last example, we're going to buy the 250 call for 26.05. And what we're going to do is we're going to try to let this play out over time. Okay. So trade number 4, a longer term setup. Backing on this is really that 3-year weekly chart showing momentum. And we're trying to use the call as a way to get the stock to go up, have the call go more and more in the money, get a higher delta, and almost have a delta, maybe if it goes deep enough in the money, maybe close to what the stock would be if you had 100 shares. So I'm going to let that kind of sit there as trade number 4. Okay. But that is, I think, something that maybe many investors are really watching here. Okay. Now I'm out of my time here today. Want to kind of make mention again, if you have not subscribed to the Trader Talk channel, do so. Simple. I can do subscribe for free. Okay. Also want to make a quick reminder that coming up next, Getting Started with Options, Cameron May. Long options. Speaking of long options, Barbara teaching those at 1 p.m. Eastern. Getting Started with Technical Analysis, Barb as well. Swing Trading, Mike Fairborn. And Building a Stock Portfolio. So a couple classes for you here today to actually review as well. And these classes have been recorded. Now remember, with what we talked about, all examples were done for illustrative purposes only. Investing as risk. And this class, again, is on Investing Master Series with 4 new trade setups here today, with a little focus on longer calls here today on the Amazon. Thanks so much, Brett, and to all of you. With that said, thanks so much. Take care. Bye-bye.